This is not financial nor professional advice. This video is for entertainment only. Hey everyone, we're living in a very significant time. These past couple years have been an anomaly like none other. In early 2020, we heard that the flu was coming. We're shutting down, we're locking down, okay? The stock market was guaranteed to go down. And so it crashed, and it crashed quickly. One of the quickest crashes in history. In the span of 2 or 3 months, we were down big time. And then Powell of the Federal Reserve, the chairman of the Federal Reserve, announced that, don't worry, folks, we got the money printer running, and we're going to keep it running because we're not going to let the economy go down. We're going to replace the economy with trillions of printed dollars, which is the source of today's inflation. But just like back then, you got a guarantee that the market was going to go up, and boy, did it ever go up. I sold before the crash. When it started to crash, and I got some of it, of course. Everybody got a little bit of it. But I got out just because they said we're locking down. How could stocks do anything but go down? But then Powell said we're going to replace the economy with trillions of dollars. We're buying assets. We're buying bonds. There's no way it wasn't going to go up. It was the easiest trade of my life and very profitable. But now we have just the opposite occurring. Because so much money has been fed into the economy that now they have to reverse course and raise interest rates, which tends to press the price of bonds down and also takes money out of the economy. And so they're going to do that 2 ways. First off, by raising the interest rates, which removes money from the economy. And also starting in June, they're going to start selling off the bonds that they bought. They put money into the economy by buying bonds. They take money away from the economy by selling the bonds, and they're going to start selling the bonds in June. So you have a guarantee by the Federal Reserve that the stock market's going to go down. At least that's the way it is in my mind. At least it's not going to go up significantly. Powell recently appeared on CNBC, and this was published on Friday, April 22nd, and he said we're going to be raising rates, and 0.5 is on the table, which he's preparing us for the big punches that they're going to start to throw with interest rates.
I think markets are processing what we're saying. They're reacting appropriately generally, but I wouldn't want to bless any particular market pricing. The thing I want to say, though, is we really are committed to using our tools to get 2% inflation back. And I think if you look at, for example, if you look at the last tightening cycle, which was a 2-year string of 25 basis point hikes from 2004 to 2006, inflation was a little over 3%. So inflation is much higher now, and our policy rate is still more accommodative than it was then. So it is appropriate, in my view, to be moving a little more quickly. And I also think there's something in the idea of front-end loading whatever accommodation one thinks is appropriate. So that does points in the direction of 50 basis points being on the table. Certainly, we make these decisions at the meeting, and we'll make them meeting by meeting. But I would say that 50 basis points will be on the table for the May meeting. Our goal is to get demand, use our tools to get demand and supply back in sync, so that inflation moves down, and do so without a slowdown that amounts to a recession. That's our goal. And I don't think you'll hear anyone at the Fed say that that's going to be straightforward or easy. It's going to be very challenging. We're going to do our very best to accomplish that. And it's absolutely essential to restore price stability. Without price stability, really, the economies don't work without price stability. We need that to have a strong labor market for an extended period of time. But the U.S. economy is very strong, performing very well. By most forecasts, we'll have another strong growth year this year. The labor
What you want to notice in his comments is he's not concerned so much about the stock market. He's concerned about the economy. They probably view we've inflated the balloon of the stock market too much, and now we need to deflate it. And so that's why he keeps emphasizing the economy. And he's under political pressure because Biden can't be happy with all the inflation that's coming through. And he's got to be feeling some pressure from them. Even though they're supposed to be independent, there will be some pressure, I believe.
The market is extraordinarily tight, extremely tight, historically so, and to the point where really there's an imbalance between supply and demand for workers. And of course, the big issue that we're very focused on is inflation and getting inflation back down to our 2% goal.
The only money I plan to be making on bonds is by shorting the 20-year bond. And I'm using an inverse fund, and it's an inverse fund on the 20-year plus bonds, and its symbol is TMV, and for every dollar that the 20-year or more bonds go down, you make $3. So it's triple leverage. It's a triple leverage inverse fund, TMV. And so that's something, and so naturally doing that, I've been reading more about bonds and refreshing my knowledge of that. And what's interesting is we had an inversion of the 2-year and 10-year bond. That's where the 2-year bond interest rates went higher than the 10-year bond interest rates. And that should not happen because you should always receive more for buying the longer term bonds, which only makes sense. But it inverts when that you get paid more for committing money for a shorter period of time, which is sort of crazy and just shows you that a recession it could be happening or could be happening within the next 2 years. And I'm going to be starting at looking at shorting the stock market. I've been doing it off and on. It hasn't been consistently down. You get these rallies and stuff. And I think right now, I think the pressure is for the market to go down. And it will depend on what kinds of earnings we get the week starting the 25th. I think Apple reports earnings on the 27th, for example. That's the marquee event. That's the main event because Apple is such a big part of the market that it actually can kind of push the market around. So I'm going to slowly get into SQQQ, but I'm going to play it. If Apple comes in absolutely awful earnings, boy, am I going to short. If it comes in with less than expected earnings, the market's going to go down. And even if they do as well as expected, the market will probably go down. Only if Apple has stellar earnings, it might hold up the market. But the way things are going, not even that's guaranteed. We saw what happened with Tesla. Tesla, its price should have gone up to 1,300 after the recent earnings. And instead, it shot up like it was going to go for 1,100, but then it shot back down to 1,000. And I think it could go down from there just because the market does not care who you are, at least. And I think Apple is the only one that can turn that tide. For now, Apple and Microsoft and Amazon, all the biggies, okay? And they're going to be reporting this week. So I'm going to be follow those blow by blow and deciding what I'm doing with SQQQ, which is a triple leverage inverse fund on the 100 largest companies on the NASDAQ. Thanks for listening and watching. Be sure to like and subscribe and hit the notification bell if you want to be notified of future videos. And I wish you the best and thank you.